And I think that dynamic is the case with many, many, many technology companies. And so I do think that investors would do themselves a favor if they sort of looked at metrics that really matter versus metrics that are not really relevant for these kinds of businesses.
All right, welcome everyone. We are joined today by Pranav Singhvi from General Catalyst's Customer Value Fund. We had a fascinating conversation with Pranav and one of the co-founders of the Customer Value Fund a couple weeks ago, maybe a month ago or so, and I just got a huge amount of value from it. Thought the way that Pranav was thinking about things, and frankly the way that this Customer Value Fund was structured was just really innovative and something that I haven't really seen done elsewhere. So I thought it'd be worthwhile to have a follow-up public conversation to talk about a lot of those same things. Pranav, thanks for coming, and why don't you tell us a little bit about your background and how you helped to found this fund?
Absolutely, and thank you, Brad and Matt, for having me. Really appreciate it, and it was a lot of fun last time. So I'm glad to be back. So my quick on my background. So I've been at General Catalyst now almost 6 years. I co-founded and run the Customer Value here, like you alluded to, Matt. And prior to General Catalyst, I was at a company called Palantir Technologies. I was there for 5 years, did all things finance there, lots of fundraising, lots of top line growth. Actually, a lot of what became the Customer Value, the original insights came about from my time at Palantir as well. So pretty excited to be here and tell you a little bit more about what we do.
So we first heard about what you're doing at the Customer Value Fund through Lemonade. So we're investors and bulls on Lemonade, and they announced about a year ago, I think it was, a deal with you guys that they branded as synthetic agents. Essentially, it's a funding mechanism to fund their own kind of customer growth strategy. This was my first foray into what you guys were doing, and could you maybe just talk us through what exactly the structure of your fund does for a company like Lemonade?
Yeah, absolutely. And I'll talk about it in more generalities than specific to Lemonade, given Lemonade's a publicly traded company, but you're absolutely right. We do work with Lemonade among many other companies as well. So, taking a step back, the insight behind the Customer Value and why we initially launched it and why it exists was when we looked at a lot of technology companies ranging from B2B SaaS companies to D2C brands to fintech companies like Lemonade to mobile gaming companies across the board. Once a company has found product market fit, once they reach a certain size and scale, a very large part of their use of capital is plowing it into some form of sales and marketing. On the on the B2C side, it often tends to be more performance marketing. On the B2B side, it tends to be more sales headcount. But the insight we had was, a lot of these companies, when they spend $1 on sales and marketing, they generate a fairly structured rate of return on that spend on that dollar. So they'll, generate 2 to 3 to 4 times that money, which is known as lifetime value over some period of time. And it was highly underwritable and very structured in nature. The thing that was bizarre to us, and this has sort of played out over the last decade or so, is all these companies finance all this using their own balance sheet, effectively equity, which is odd because if you think about the ROI on sales and marketing, it's range bounded. If you spend $1 on CAC, you might get 2 or 3 or 4 times your money, depending on your lifetime value unit economics. But the cost on your equity is not really capped, right? It's permanent capital. You give it up forever. Usually when you use something with an uncapped cost to fund a capped return profile, that's not a very prudent thing to do. But unfortunately, in the tech world, you celebrate it on TechCrunch and other places. It's never really made sense to me. And so we sort of dug in very deep into this and try to ask a lot of initially our own founders here at General Catalyst and even otherwise as well, how do they think about capitalizing themselves for long-term growth? Why are they using so much equity capital to fund what looks like a highly structured return profile? And the consistent response we kept getting back was, even though we were right about the fact that the ROI on sales and marketing is highly structured in nature, the issue with traditional debt or variations of debt, that existed in the market was that the risk with debt is not isolated to the investment in growth. So if you take debt to fund your growth, and the growth has variability associated with it, let's say you take $1 of debt and you invest it in sales and marketing, and that lifetime value on that specific cohort that you invested in to acquire just did not pan out. It took longer to pay back or didn't pay back at all for whatever reason. The entire company is on the line to pay that debt back. If you really sort of double click into it, what they were getting at is a very well-known problem in finance, which is an asset liability mismatch, right? You have a liability that's fixed, and you're using that to fund an asset, which is the cohort here, that has a variable payback. And in essence, that fixed liability and variable payback on the cohort causes sort of a huge asset liability mismatch for companies over time. And this is the reason you find, even though the return on sales and marketing has quite a bit of structure to it, companies hesitate to use any debt to fund their growth. And that's what eventually led to what became the customer value, which is we said, well, okay, it's interesting. The asset liability mismatch is a very valid reason to not really, use that source of capital to fund your growth at scale. But asset liability mismatches have been around for a while. What are ways people have gone about solving them? And in essence, what we said is, what if we came in and said, we can solve this problem by providing a source of capital that is exactly aligned with the performance of the asset. And I'm using the word asset loosely. The asset is the ROI on that sales and marketing, so the cohort and what that cohort pays back. We call it, even though it's not a hard asset, you don't capitalize it on your balance sheet. We think of it as a statistical asset. It has some probabilistic set of outcomes associated with the investment that someone makes in sales and marketing. And so that's what we proceeded to do, where we said, now we go to companies and say, we will fund your ongoing sales and marketing spend, customer acquisition costs, go to market, whatever you want to call it. And we will only get paid back from the specific assets acquired from that spend. So the specific cohorts of customers acquired from that spend until we hit a target return. Once we hit our target return, the entire lifetime value of that cohort belongs to the company. However, if that cohort underperforms, takes longer to pay back, or doesn't pay back at all, we share in the downside risk. And this is very important because this effectively solves the asset liability mismatch that I was alluding to earlier. But more importantly, it gives the company the ability to scale its sales and marketing in a way that has historically not been possible. And so that's the dynamic we've seen with many of the companies that we work with, and have been pretty excited about that.
So there's a lot to unpack there, a lot of different directions to go. But I want to maybe just start with, thinking of some of your younger type of companies that you might be working with, where you said this in our conversation last time, your sales and marketing, function, or your asset, as you said, is one of the only, extremely high, like, positive ROI items in a company's cash flow profile. All the overhead, your staff, your office that you're renting, those all drag down the ROI of your kind of outstanding customer acquisition asset, as you alluded to. And so you're essentially taking, very expensive venture financing or some other cost of equity to fund, the entire kind of mix of cash flows, the highly accretive, highly performant customer acquisition strategy, as well as all the overhead and everything else that kind of goes along with it. Can you maybe just unpack that aspect of it a little bit also, and then maybe also just the piece of the idea of adding a debt-like instrument to a startup company or someone kind of struggling with cash flow can sound like it potentially increases the probability of bankruptcy. I think you alluded to why that's not the case with you guys, but maybe expanding on that a little bit would also be insightful.
100%. So to your first question, it comes down to how we actually think about these businesses. So from our perspective, late stage technology companies, so companies that have found product market fit. So, this is not a product for early stage companies, seed, series A, series B, sometimes even series C is too early. These are companies that are scaled. They're spending on sales and marketing. They have a good ROI on sales and marketing, and they just need to sort of pour more fuel on the fire, so to say. Now, when we model and think about these businesses, in reality, late stage technology companies are really two sub companies. And so what I mean when I say that is, to your point, they have a part of their business that is, in a sense, coin operated. They spend $1 in sales and marketing, and that generates an ROI in excess of $1 over some period of time. And there's quite a bit of structure associated with that. And that's sort of what we call the CAC machine, if you will, sort of the customer acquisition machine for the business. And then there's a second part of the business that effectively takes the residual lifetime value left over from the investment in customer acquisition cost, and funds the rest of the OPEX of the company, which is your investment in product, engineering, operations, anything else that you may be investing in. You can almost think of this as the operating company that enables the company to have its CAC machine scale. And so the residual lifetime value from the first sub company, the CAC machine, funds the non-S&M OPEX, so the non-CAC OPEX of the second company, in addition to any excess cash the company has on its balance sheet, if you will. And so when you model the business this way, to your point, the ROI on sales and marketing is what's actually funding the investment on the operating company. And keep in mind, the operating company is very important because the operating company is what gives the company the ability to have sort of the long-term investment in sales and marketing and scale it over time. But the actual investment in sales and marketing is extremely positive ROI that effectively subsidizes the longer-term investments that you make in product engineering that may not have a near-term clear ROI, but are important and critical for the long-term value of the company, if you will. So we really model these businesses as these two separate businesses. Now, historically, it's all been lumped together and it's all largely been equity finance with maybe a little bit of corporate debt. And every now and then someone gets like a line of credit that they never use, that kind of thing. Nobody's actually double clicked into making these sort of businesses much more higher resolution in parts of how much risk that they own. So what I mean when I say that is the CAC machine that I just alluded to is largely de-risked. If you isolate that part of the business, it ought to actually have quite a bit of leverage in it and in the way it can be financed. But unfortunately, historically, everything's just been a singular product to fund all these businesses. And so that's sort of how we think about these companies. And in a sense, when you start thinking of the world this way, something interesting happens, which is when you sort of remove the CAC machine, or effectively the investment in sales and marketing and the ROI on sales and marketing from a company's P&L, you almost treat it as an asset that can be taken off balance sheet. These companies are highly cash generative in nature. It's almost like, we internally think about these businesses not in the context of EBITDA, but actually EBIT CAC, which is if you remove CAC from sort of the earnings of these businesses, are they cash generative in nature? Because that's really the fundamental profitability metric for lots of these companies, because CAC is a discretionary decision they're making to invest for a higher ROI, which on a GAAP P&L statement ends up looking like making the company look unprofitable, when in reality, it's an investment that they're making that will generate a good ROI. So, when you take a step back from all of this, you sort of split the business out into these two components and then really think about the business on what we call an EBIT CAC basis. Most of these companies that we work with are generating quite a bit of cash when you remove sales and marketing. And so this sort of then gets to your second question, which is, these companies don't have going concern risk in a traditional sense, largely because they're choosing to invest in sales and marketing. That's why they look like they're burning a lot of money. But when you actually remove that discretionary investment in sales and marketing or customer acquisition cost, they're actually quite profitable in nature. And if we come in and finance that quote unquote asset, then effectively the company can keep scaling from a source of capital on that invest in their customer acquisition costs and continue to just generate excess cash on the operating company. Because as we hit our caps or target returns on each of the cohorts that we help finance, all that excess cash and the lifetime value of that cohort that we help fund eventually reverts back to the operating company. And so you just see a dynamic where these companies just sort of start generating quite a bit of cash over time.
Yeah, this was a light bulb moment for me when you said that the last time. So, I mean, if you were to think of a traditional manufacturing company who spends a lot on equipment in order to grow their future sales, you get to capitalize that that spend on the balance sheet, and then it gets depreciated over time as you kind of incur or as you realize the value from that investment. And so that's why EBITDA has become this incredibly important metric, because it's the DA, for people who aren't as big of a finance nerd as you or I, Pranav, is depreciation and amortization. But for that, like Lemonade has very minimal CAPEX, but is spending a lot of money to generate a future stream of cash flows that is very similar to what you get from investing in physical property, plant, and equipment. The GAAP rules dictate that you take the entire hit for that investment in the initial period, even though you've got this long tail of customer value behind it. So what I find so remarkable is like this is a very obvious thing, but nobody's really done this to my knowledge, at least before you. I mean, it's almost like you're kind of creating a new type of financial reporting by looking at it this way. I mean, you're not following GAAP essentially, but you're following cash flow, which is like anyone who's taken finance 101 knows that like cash flow, cash is king, cash is like the most important metric. And so you guys are tracking that extremely closely. It's not like you're ignoring GAAP completely, but you're seeing what really matters for maximizing the ROI of the entire business. And so I thought this was just a kind of brilliant thing that you guys have done. And I was honestly surprised. Like, that's so simple. Why hasn't anyone else done this before? It was just kind of eye-opening.
Like I said, I've been at this for a couple of years. I ask myself that same question every day, and it's still shocking to me how often it's one of those things that once you see the world this way, there's no going back from it. But it just takes some time to get there, and once you're there, it's sort of is. But the comments you just made, Matt, especially around the traditional, call it industrial world or manufacturing world, is so spot on. Interestingly, I'm actually working on a piece right now that's titled "CAC is the new CAPEX," and EBIT CAC should be the new EBITDA. And if you sort of take a step back again, I don't know how much y'all know about the history of EBITDA, right? EBITDA was created by the great John Malone, and he created it when he realized that net earnings, which is how people used to track the profitability of companies, was not a great metric for, I think it was cable businesses, largely because cable businesses required a lot of investment in CapEx, and therefore they had a lot of depreciation expense on their P&L. And so investors, mispriced those companies because they were looking at the net earnings of those businesses. When John Malone came along and said, wait a second, if you add back depreciation, these companies are generating so much excess cash. That's the real earning power of these businesses. And that's sort of how EBITDA came about. I think there's sort of a similar analogy here for tech businesses as well. When you look at traditional manufacturing companies, to grow, they have to invest in CapEx. They capitalize that CapEx and then they depreciate it. And often that CapEx is, manufacturing companies look more profitable largely because they're depreciating that CapEx. In the tech world, there is no CapEx, it's CAC, because you're expensing it all when you spend it. And so the companies look unprofitable when in reality, it's CAC has all the properties of an asset. And in theory, if you capitalized CAC, these companies would actually look quite profitable as well. And so I do think there's something to be said about whether we can sort of blame GAAP accounting and all that. It's just much more eventually, as an investor, part of your job is to know where GAAP accounting breaks and find those mispricings. And I do think that there is a moment to do that today with many of these technology companies that are getting hammered for being quote unquote unprofitable on an EBITDA basis, when in reality it's the discretionary decision they're making to invest in sales and marketing that generates a very high ROI.
So for tech companies, they can measure their CAC, which is customer acquisition costs. They can measure their lifetime value of their customer. They can get some history behind that, measure it. They can see how it's changing over time, how your customer acquisition costs are increasing or decreasing, and the same with your lifetime value. But what we're saying is, when you're spending that money on acquiring the customer, it's not being considered an investment. It's just being considered an expense.
Yep.
Whereas like with a manufacturing company, if they make something, it's considered an investment. It goes into inventory at cost. But it's not the same for sales and marketing. So if it's very measurable and predictable, this is what we're talking about. And that's why we happen to be attracted to Lemonade. We don't have to talk about Lemonade now, but a whole lot. But like Lemonade, their lifetime value of their customers like 4-to-1 ratio compared to their CAC. So it's like the value of that customer today is $4 for every dollar they spend on sales and marketing. So they want to do that as much as possible, but they're limited on their cash. So really what investors should do over time is begin to track how that cash flow is changing with Lemonade. And as they're able to begin to look at the sales and marketing more as an investment rather than an expense.
Yeah, and one of the things that's interesting is that this trade-off in the traditional manufacturing world didn't exist in the same way, right? Largely because people got asset-backed financing for machinery, right? They were not using their own balance sheet to fund this. And part of how I think about what we do is we're just creating asset-backed financing for sales and marketing. But you're absolutely right, which is whether it's with Lemonade, and again, taking a step back and thinking more broadly as well, all these businesses, they're making a discretionary decision to invest in sales and marketing that creates an asset in the form of lifetime value over a period of time. Unfortunately, it doesn't show up on their balance sheet, and the CAC looks very negative because it's expense in the moment that it's invested in. So I do think that a lot of investors should take a step back and, like you alluded to, think about that a little harder and what that actually means for the long-term enterprise value of the company. Because not only does this play out in the fact that the company, looks unprofitable when it invests in CAC, it's even more important as to how the company should be thinking about scaling its investment in CAC. And what I mean when I say that is, in reality, if you sort of today, many companies constrain their spend on CAC based on a balance sheet constraint. That's frankly like just random, right? Who decides that 18 or 24 month or 30-month payback is the appropriate payback target for CAC, right? In reality, that should be an output of investing more in CAC until your marginal CAC equals your LTV, right? This is just marginal revenue equals marginal cost. That's how you maximize profit. But today, companies just kind of make up stuff around what a good target payback is based on, frankly, what's borderline astrology, as far as I can tell, versus actually being mathematical about, let me keep investing until my marginal revenue equals my marginal cost. My marginal cost is my marginal CAC, and my marginal revenue is the NPV of my lifetime value. And so that's in reality how you should be operating a business. But because if you keep doing that, your EBITDA looks very negative, you sort of get hammered by investors, even though that's the right thing for your business to do.
So let's talk about that a little bit, Matt. You're the CFO, you're the CEO of a company. You feel pressure to show earnings, but you have this thing over here where your sales and marketing can get you a great result, but you're being punished by how the accounting works.
Yeah. So, I actually used to work for a company where the goal, how they managed the business, was exactly 7% earnings growth. Like that, for whatever reason, they just wanted to have 7%, not 6%, not 8%, because then it might be harder to kind of, carry that forward. But it was like 7% EPS growth, with a 40% payout ratio was like their goal, and the only thing they really cared about when they were talking to investors. And I was like looking at some of the decisions that were being made when that was the priority, and I'm like, you're like spending more on like problems that the business has by like trying to manage the timing of a particular expense item, instead of just saying, hey, like what's the lowest cost way to handle this? Like what makes the most sense from like a business standpoint? So I think your comment, Pranav, about like some astrology kind of being at work was spot on, because I think if you do see the world in this way, this kind of unique way that you were alluding to, is where you've got the real source of value for your business, the way that you're creating enterprise value, or share price value for people who maybe aren't as big finance nerds, it is by having positive ROI investments, essentially. And so if it's true that all your overhead and your developers, everything that you need to support your back office is always going to be a drag on the business, then what you should be doing is trying to maximize the amount that you are spending on your customer acquisition, so your CAC that we're talking about, this is something we've been talking about on the Lemonade earnings call. So like right now, their LTV to CAC, lifetime value to CAC, is around 4. If you keep spending, that might drop to 3 and might drop to 2 and might continue to drop as you increase the bucket of spending. But if you run the cash flow analysis of what would happen if they did that, that would unless there's a problem with your LTV assumption, yes, which is extremely trackable, so it's not, I think, reasonable to think that would be the case. But that will almost certainly result in an increase in enterprise value for the company over time. Whereas, if you're instead saying, oh, we don't want to take the big hit to earnings right now, so we're only going to invest 20 million this quarter, even though we could double that. your earnings, your short-term earnings are going to look slightly better, but you're leaving off all these customers that for years into the future could be contributing positively to your earnings per share, to your EBITDA, whatever metric you care about. And so it's just like it seems so kind of obvious to me that a way that companies should be viewing this. I think I'm just repeating what you said, but I think it bears repeating. It's such a profound and different way of looking at things.
It absolutely is than the way companies have been viewed, at least in the tech world and the world I live in. It is sometimes shocking to me because a lot of this is just finance 101 and capital allocation 101. The fact that you should spend until your marginal CAC equals LTV even feels like a novel insight is a little scary to me, because I'm like, guys, this is econ 101. Like, what are we talking about here? Why is this a novel insight? When I talk to many founders and companies, but even putting that part aside, your point is absolutely right, because you won't a priori know what your lifetime value is. So the way we obviously always tell our companies to think about this is to make sure that they're being conservative in their lifetime value calculations. These are highly measurable metrics for many businesses today, but even then, you ought to be conservative. But even after you're conservative, you will realize that by kind of just arbitrarily constraining yourself on investing in customer acquisition costs, it ends up being a huge drag on enterprise value. And it doesn't show up until a few years after, right? And it can show up in the form of somebody else really sort of realizing this and getting ahead of you, or and this is the conversation I'm having with many founders and companies now. They're all like, oh yeah, we're focused on profitability. And I'm like, okay, great. So once you get to profitability, then what? And they're all just like, oh shit, we never thought about that. What do we do after we become profitable? It's like, no, you got to grow. The whole point is to build a big business. It's like, great. Yeah, I understand you're focused on profitability. And I'm having these conversations and I'm like, great. Let's say you get to profitability. Now what? It's like, oh shit, now we still got to grow. It's like, exactly. So like the whole point is like this movement towards, I guess, profitability becomes this like, topic du jour over the last 12 months for whatever reason. I think the definition of profitability, the pursuit of profit is very noble. As a capitalist, I'm very, very in line with that. However, the way you measure that profit is important, and I do think that thinking appropriately about fundamentally, if you are profitable, which is remove your CAC, are you actually in a place where your unit economics are positive, but also like your existing cohorts of customers that you've acquired are sufficient to fund your non-S&M OPEX, so you're kind of default profitable. Now you're making the discretionary decision to invest more in growth because the ROI is worth it. To me, that is a profitable company that's doing the right thing. And so their EBITDA may look negative, but they're fundamentally profitable.
So what we're talking about at the highest level is taking as much profit from the sales and marketing side, or capturing that as much as possible. You're capturing as many profitable customers as you can. So then Pranav or Matt, what happens with the rest of your business? Like, what's the implications for the rest of your business beyond sales and marketing?
Well, you've got to keep investing in the rest of your business to keep. So let's play this scenario out in the extreme case. Let's say you have a company that keeps spending to a marginal CAC equals your LTV. Well, now you've reached the steady state in how much you can spend on CAC. Now, if you want to scale as a business beyond that, and you will know that a priori because you're investing in sales and marketing up until you get there, and what your max LTV is. Well, all the excess cash that you're generating now as a business, you've got to be investing in the operating company to increase your LTV. That can mean new products, new business lines, new geographies, whatever the appropriate thing for your business to do is at that point in time. And so again, it's sort of a classic cycle, right? Which is you invest in sales and marketing to generate the ROI on CAC, keep investing until your marginal CAC equals LTV. All that excess cash that gets generated from the residual lifetime value of what you're investing in, reinvested in the operating company to start increasing your lifetime value again, which then gives you the ability to go invest in CAC again, where you can increase your marginal CAC until you increase your LTV. Now, you keep doing that cycle until you reach a point where you're not sure in the near term what that excess cash can be reinvested in. And that's when you start thinking about, returning that back to shareholders, whether it's in the form of buybacks or dividends. This is, again, all like sort of classic capital allocation 101.
So I'm curious what kind of conversations you have for founders who or business operators who are coming into this way of thinking for the first time? I mean, I could imagine potentially being a founder who's like, got a 5-year, budget or forecast or something like that all set up. And then you come in and you basically imply that, if I follow your logic, it maybe what you're suggesting is that I should be spending like 3 or 4x more on my marketing spend potentially. For every company, it'll be different, but that might be like a very disconcerting pill to swallow. That like not only was I wrong by that much on how much I should have been targeting, for my sales marketing budget, but also like that's a fair amount of resources to throw towards something that'll like I'll go from being EBITDA negative to really EBITDA negative once I if I follow this advice. So what kind of pushback or concerns do you see from founders? And I'm curious what of the pushback is kind of justified or reasonable, and what is just more I haven't looked at things this way before. This seems uncomfortable.
Yeah. So look, the most justified way of thinking about the pushback here is it is relatively new. What we do is relatively new. I don't think thinking about the world this way, like, should be that controversial. It's just that engaging in actually perhaps what may look like a relatively novel financial product. And so it's sort of the just dealing with something newer. The comment you made around your EBITDA starts looking very negative, but the flip side of that is your cash balance starts flying, right? Because today, if you used to spend money to invest in sales and marketing and you get paid back over some time period, you're tying up so much of your own balance sheet in sales and marketing. If somebody else now finances that, yes, your EBITDA from a P&L standpoint looks negative, but your cash balance starts going up massively. And I think this is the dynamic that most companies that we work with tend to experience. So it's dealing with that, like that newness associated with it. And look, the expectation never is for founders to dive head first into it. Just sort of ease into it if it's something that you're still sort of thinking about, and it's not like you have to triple sales and marketing spend overnight. And I don't think that ever is a good idea for most companies. But you instead of thinking about your budget purely on a balance sheet constraint standpoint or a P&L constraint standpoint, which are sort of the two main constraints that companies tend to put themselves in, there is probably a different way of thinking about the world, and that just takes some time for people to get comfortable with, to your point, where often they may have created a budget and so on and so forth. The pushback that I find very fascinating from founders and CFOs, outside of just the novelty of it, which I think is the most rational reaction, is that it's newer, and so how do I get comfortable with something newer? And look, we've built now enough reference points and whatnot as well that exist. We work with a public company in the form of Lemonade who are seeing the impact of it as well. Many founders and companies are like, oh, but I have cash. I can just use that cash to invest in sales and marketing. And that's always bizarre to me, because I'm like, well, that cash has a cost that's way more expensive because it's your equity. And going through the conversation of making people realize that their equity is not free, even in this market, I think is quite fascinating. Like the number of conversations I have, and I mean, I kid you not, there are CFOs of very large companies that you've heard of that say things like, well, isn't equity free besides the dilution? And I'm just like, oh my gosh, I think it's time for me to end this call. I'm not sure this is a company you should ever work with. And so
someone who started my career in valuation and like building up cost of equity, on a regular basis, it just pains me to know that that's such like a common misperception out there.
The issue is they view the cash that they've raised on their balance sheet as effectively free. And I am often trying to sort of point to them, listen, if the cash that you've raised on your balance sheet is free, just remember the investors who gave you that money, their rate of return is zero on it as well, right? Like both of those things are true. They have to be congruent. And so I think it takes some time to understand that. And then from there on, it sort of just comes about like, okay, great. If I do start using this, I have cash on my balance sheet. This will help me create more cash on my balance sheet. What do I do with that now? And that's the real discussion. It's like, great, now you have excess cash. What were things you were going to do that you are not doing today that now this unlocks? It could be more investment in growth, more investment in sales and marketing, if that's the right thing for your business. If not, maybe you want to sort of invest more in product and engineering to start increasing your lifetime values. And if not that, you may want to start building the cash balance to fund future M&A. And if not that, then you may want to start thinking about giving that money back to shareholders. in the form of buybacks and dividends. So all of this is sort of a simple algorithm of capital allocation 101. And often the starting point is making people understand that their equity, which is their cash on their balance sheet, is not free. That is the biggest struggle outside of the irrational, just the fact that it's relatively novel.
So I'm kind of curious, what was you mentioned how, some kind of disconcerting conversations with CFOs who think their cost of capital is free. I would imagine that would have been even more amplified, in the middle of, all the stimulus funding of, 2020, 2021. Have you noticed a kind of any change in demeanor or like more of a return to fundamentals, which I would think would kind of benefit the customer value fund? I'm curious how it's changed in the 5 years that you guys have had the fund.
Yeah, I mean, look, I would say that people perhaps are maybe more open to having a conversation, but at the end of the day, a lot of the thinking around how technology companies should be capitalized is a byproduct of a decade to 10 to 15 to 20 years of very, very easy capital. So even though people are open to having a conversation, it's not like they've learned basics around capital structure, right? Like the conversation I just talked about where people think the cash on their balance sheet is free is a conversation I literally have like every week, right? So that thinking has not gone away. And I think that's actually more a byproduct of the fact that we haven't taught our founders and CFOs to think about capital structure intelligently. And it's not that, it sort of trickles all the way up and even to the board members, right? You have board members who have not thought about capital allocation in an intelligent way either, or never had to think about capital structure. So I think this is something that requires some time, education, and sort of will trickle down over time into, the people who make the right decisions, it will be very clear like 3, 4, 5 years from now, like what their enterprise value will look like as a business. And the ones who don't, will sort of pay the price accordingly as well. So I think that it's just, while definitely that people are given sort of the capital constrained environment now, people are more open to having conversations, but it's not changed the way people think yet in terms of how they should be capitalizing their companies. The other big thing that has happened is, right, over the last, again, 12 months, because of the capital constrained environment, what a lot of companies have just done is they pulled back spend. They pulled back spend on sales and marketing. And so they started, when you do that, most of these companies start generating cash pretty quickly. And so now they're all like, oh yeah, we're profitable. And I'm like, great. Now what? Like, you're profitable. So like, are you going to build a big business or not? Like what next? And so they're all in the what next phase now, because they've all pulled back spend. And so they're like, we don't need capital. We're profitable. And I'm like, okay, but you are using your own equity to fund growth, even if you are profitable. That is your equity, last time I checked. And so it's just sort of that this is probably going to be one of those things where, the dominoes slowly start to fall and they fall very, very quickly after that, is my guess. Who knows? But either way, I'm excited to work with companies that think this way, because I do think that the results will speak for themselves over the coming years. And to many extent, we've been working with many companies for a few years now, and the results really do speak for themselves.
Yeah, I think companies need to focus on scale, and this is a crucial piece where you can focus on scale. And I think investors need to be open to looking at other ways, looking at companies in different ways. So, focusing more on cash flow, and not being as hardcore on earnings, like cash flow from operations. What's the delta between R&D and the rest of the company, and the unit economics of the business. So this has been a great conversation, and I really appreciate it. And it's been eye-opening for us.
No, absolutely.
So I have a couple other questions, if you don't mind hanging around for just a minute longer. So I wanted to talk about like just the logistics, the blocking and tackling of what you actually do. So I mean, for people who are familiar with Lemonade and the synthetic agents deal, is essentially it's not that Lemonade is just getting debt financing and there's no risk participation. You already kind of alluded to this earlier, but I think the logistics of how you're actually tracking the performance of each one of the cohorts that you are funding across all your companies, and then essentially like the infrastructure that you've built up in house. It sounds pretty impressive. So could you talk a little bit about how you are actually tracking the results to know what the performance is kind of in real time?
Yeah, absolutely. So, me and my co-founder KV, who you'd met on the last call, we're both data people who taught ourselves finance. So we're both worked at Palantir. So we're really data infrastructure people who taught ourselves finance, not the other way around. And as part of that, right, pretty much when we think about these cohorts that we invest in, the asset that we invest in, one of the reasons the customer value fund is possible today, and I'm not sure it would have been possible 10, 15 years ago, is purely because of the rise of the cloud. What I mean when I say that is all these companies today in their go-to-market functions, they have to centralize, they often centralize their data in a data warehouse like Snowflake or Redshift or BigQuery or sort of, some form of a cloud system. And what that's enabled us to do is build our own data platform that syncs into those raw transaction systems live. And so we pretty much ETL is extract, transform, load, to actually get the raw data from every single company we work with in a live manner, whether it's via a sync that they set up or we sort of find a way to sync their data into our databases on an ongoing basis. And we basically built the entire infrastructure to monitor how their cohort performs live. Right, live meaning we literally get this update, the data updates anywhere from hourly to daily, depending on sort of the nature of the business and so on and so forth. And we monitor their cohort performance live. That's because that's the risk we own. And it's important for us to understand what that actually looks like. And to your point, this is not traditional corporate debt, right? We own the risk on the specific cohort. And so that's a key part of what we've been able to do, but also more importantly, scale. This fund scales much more like a software company would scale, largely because we're not sitting here analyzing qualitative stuff that doesn't scale. It only scales with humans. It's much more systematic in nature. It's almost like the data platform we built. I think of almost like a trading system of sorts that in essence prices the risk associated with these cohorts on an ongoing basis and makes decisions as needed. And at the bare minimum, we also try to share back as much of we have with our companies as well, to show them, hey, every month you're getting a report from us that says this is what your return on incremental invested capital looks like. Just so you know, this is what we're tracking, and this is how we think about your investment in CAC as a third party investor, if you will. Interestingly, somebody described the CVF in a very interesting way to me. They said you're almost like a free market driven way to let the company come up with how much they should be spending on CAC, right? Because we own the risk on it, right? So we're basically like companies always have these internal debates on what the appropriate level of CAC spend is, and we're kind of like third parties who own the risk, and we say this is what we believe is right because we own the risk on it. So it's almost like a free market driven way of coming up with the appropriate level of CAC spend for many companies.
Yeah, I mean, I could imagine if I was a CFO and I was getting these reports, that'd be extremely valuable information. And I think it would. I mean, the information itself certainly valuable, but also, I mean, it would prompt I think the natural question is, hey, if you're willing to you are owning the risk of increasing my CAC spend. If you are saying you are comfortable essentially lending more to enable this activity, that should give me as the CFO a lot of confidence that that's like a prudent thing to do for the business. So, I mean, I would think if you're, maybe an advocate that needs to go to a board meeting or something like that would be pretty powerful ammunition to have some of these reports, and to have an independent company like yours, kind of looking at it and saying, yeah, this is what we see, and we're comfortable with the risk profile, and the incremental spend is, or the incremental LTV to CAC is here, and so we're open to additional spending. I mean, it just seems like extremely valuable business intelligence. I mean, I know this isn't your business right now, but I mean, I could imagine, like, I don't know, somehow monetizing that software that you built. It seems like a very novel way of looking at it.
Yeah, I mean, look, versions of that happen already today. To your point, it's not something we're thinking about in a first class way today. We may in the future. Right now, our goal is to help finance these companies' sales and marketing, and that's where our focus is. But it does happen where often when the company is going to its board to increase budgets and things of that nature, a lot of the work that we do and we share back with companies is a huge part of the support package to go do that, because often, the board members end up being equity investors and they have a certain view on what the appropriate payback on their CAC should be. But it's much easier if a founder can go to their board and say, you know what, we understand your view. Guess what? We found somebody who will fund our CAC, and their view is different. And so this is how we're going to think about the world. And unless you have some specific reason that you think this doesn't make sense, it just creates for a much healthier dynamic when you have somebody that's very deeply aligned with the ROI on sales and marketing versus somebody who's sort of thinking of the world much more in perhaps getting their next markup on a deal, which is sort of what you see with traditional equity investors, or really trying to make sure the company can survive long enough to not have a subsequent equity raise and things of that nature, which is sort of a very different way of thinking about the world.
Yeah. So what kind of companies work best? And, if somebody either, works at a company, is managing a company that hears what you're saying, says, yeah, that makes a lot of sense. I'd like to, potentially work with the customer value fund to increase our own CAC spend. What's the best kind of prototypical company that you might work with, and how best could somebody like that reach out to you guys?
Yeah, so it's probably easiest heuristically to think about spend on sales and marketing. So basically, on the smaller end, anything less than, call it, 1 to 2 million a month of sales and marketing spend is probably too small for us. Most of our deals are between, call it, 3 and 30 million a month of sales and marketing spend that we fund off our balance sheet. That's number one. Number two, I'd say you need to have customer lifetime value. So if you're a business that is more one and done, meaning you realize the lifetime value of your customer at the point of sale, there's really nothing for us to do. You may be a great business, it's just not a good fit for us, just because you don't really have lifetime value in your customer base, which is sort of some form of repeatability. And then three, as a business, if you remove CAC, if you remove sales and marketing, you don't have going concern risk, right? So you're basically default generating cash if you remove sales and marketing. And that basically gives us the comfort to say, okay, you have the ability to spend at a decent scale, and you've proven that, so you have some data we can underwrite and so on and so forth. Two, you actually have lifetime value that can help you scale that spend that you may be already investing in. And three, if somebody does fund your sales and marketing as a business, you're never relying on future subsequent equity raises. You don't need any future cash injections. You're default alive, in essence, that if you stop spending on CAC, you start generating cash as a business.
Yeah, it's an awesome business model. I mean, like I've said several times, I just can't believe that, like, nobody had thought of this before. It's so basic, kind of finance 101. But I just love the conversation. Love what you guys are doing. It seems so obvious. I mean, when we're looking at Lemonade, just for example, everyone's been focused on, EBITDA, the earnings losses. And I was taking a lot of time kind of modeling out the cohorts in kind of detail based on some of the public tidbits that, Daniel and the company had put out there. And I was coming up with them, being cash flow positive by the end of this year. And I thought that was already a public announcement. And then on this last earnings call, they said, yeah, we're going to be cash flow positive by the end of the year. I was like, oh yeah, that's old news. And then I realized that surprised the market. But people, I think, are really underestimating what a cash flow benefit this funding mechanism can be. It really, like, for any company that you're looking at, even if you don't really care about this, customer value fund, look at the cash flow. I mean, looking at the difference between EBITDA and cash flow on these businesses is extremely high. And I think when you play this the story forward a couple of years, like you were saying, it's going to be really obvious the customers that have invested appropriately and their enterprise value is going to be rewarded because they've been kind of growing and taking the EBITDA hit to grow the enterprise value.
The part that's surprising to me that, this is a conversation that's age old, right? Like, this was sort of Amazon circa the whatever, early 2000s. And then again, it's just a variation of the same insight that John Malone had about cable systems businesses as well. And even more recently, for the longest time, people criticized Uber for not being profitable. Well, actually, if you removed sales and marketing or CAC, Uber was fundamentally quite profitable. And as the cohorts stack on, you kind of see the results now, right? The ride sharing business fundamentally seems like a very profitable business. You just need time for the cohorts to stack on. And I think that dynamic is the case with many, many, many technology companies. And so I do think that investors would do themselves a favor if they sort of looked at metrics that really matter versus metrics that are not really relevant for these kinds of businesses.
Well, Pranav, thank you so much for your time. Anything else we didn't touch on that you want to make sure people hear before we wrap?
No, really appreciate you guys taking the time and having me. Thank you so much.
Also, it's another great conversation. Thank you so much for joining and for what you guys are doing. I just love it. I mean, I'm not really directly benefiting from it, but I just love the kind of like return of finance rationality to the markets. And I think what you guys are doing plays a big part in that. So love it. And just excited to watch you guys. I think you're going to continue to grow and do really well just because it's common sense ideas like this are bound to succeed. So thanks so much for what you're doing, and love the conversation and looking forward to keeping in touch over time.
Thanks, Matt. Thanks, Brad.